What is credit card churning? Credit card churning is the process of applying for credit cards and getting the most of the initial rewards before moving on to the next credit card, and then you repeat the process. As you may know, credit card providers offer bonus sign-up, usually in terms of points. For example, Amex gives you 30,000 points when you spend £3,000 during the first 3 months. In that case, what people might want to do is apply for the credit card, spend £3,000 during the first 3 months, then move on to the next credit card. Remember, the golden rule with credit cards is to use it to pay for your current expenses. Do not spend more than what you would usually. Ideally, it replaces your debit card. Credit card churners, as I call them, are very well aware of the rules to make the most of the credit cards. But while credit card churning is not a new concept, it has gained more traction after famous personal finance YouTubers like Graham Stephan have popularized this technique. In his videos, he explains how he travels the world for free and how he makes the most of credit cards from the sign-up bonuses. So while credit card churning gives you a huge boost in rewards, it also has its drawbacks. One drawback is that applying for many credit cards may damage your credit score. This can sometimes be interpreted as someone needed a lot of credit and perhaps not financially in a good situation. Another drawback is that if you're not careful and not following the essential rules mentioned above, you may find yourself in debt and the interest rate wipes out any benefits you get by credit churning by far. One thing to also remember is to cancel the card if it has an annual fee. Credit card providers despite credit card churners. To understand why, let's look at what their ideal customer would be. First, they want a customer who is earning a decent income but not too financially savvy. The decent income ensures that the customer has the means to repay the debt, as they don't want to lose their money, of course. But also, they want someone who doesn't realize that paying interest is bad, as these high interest rates plus compounding are extremely bad. That customer will then go on paying the bank huge amounts of interest, not clear their balances in time, and effectively become a financial slave to the system until either they go bankrupt or eventually clear their debt at a total cost several times their initial debt. The credit card providers would love that because that means they make a huge return, obviously. That is one end of the spectrum of customers. At the other end of the spectrum are the smart customers, which include those credit card churners. The smart customers know the rules very well and monitor every card. They pay their balances in full and on time. Basically, they take advantage of all the rewards and offer very little profit to the credit card providers. This is because they don't pay any interest, manage to avoid the late payment fees, annual fees and other charges. Remember though, the credit card providers still charge processing fees to the merchants, so they still get some sort of revenue when you pay using your credit card. This is why some places don't accept Amex, because their processing fees are simply too much for the merchant compared to Visa or MasterCard. I saw this comparison online on Value Penguin of the processing fees of Amex, Visa, MasterCard and Discover. These charges are for the US, but the same principle applies in the UK. As you can see, a 3.5% charge on a business operating on a thin profit margin is a deal breaker. But anyway, back to the credit card churners discussion, you can easily see why the providers don't really like them. Consequently, those credit card providers have become stricter with the terms and conditions, as well as additional rules to counter credit card churning. To illustrate this point, remember the Amex example earlier where you got 30,000 points for signing up? Well, if you click on their terms and conditions, you will see that this offer only applies if you have not held a personal Amex credit card for 24 months. That's right, 2 years. And with other providers, they may also have other rules like a minimum regular expenditure or clauses in their T's and C's to avoid those sign-up bonuses. So if you intend on credit card churning, it's a good idea to read their T's and C's as you're legally bound by them. If you already have credit card debt and you're wondering how long will it take you to clear it, why not try my credit card calculator on Questionnaire.com. As you may know from my previous video, I recently launched a series of personal finance calculators online, and one of them is the credit card calculator. All you need to do is just enter your details and voila. Don't worry if you don't know all the values, as the default values are already preloaded and you can simply use that. I will do a full tutorial video soon. But back to credit card churning, if you're contemplating the idea, do check moneysavingexpert.com, who are constantly on the lookout for brilliant credit card deals. It's really worth bookmarking. Also, if you like exploring money hacks, feel free to check out my playlist at the end of the video. So that's it from me. I hope you like this video. Thank you for watching. Until next time.